All businesses face significant change, particularly in the prevailing environment. One of the mechanisms for managing that change and managing the risk associated with that change is the use of a captive insurance company. I'll talk you through what exactly a captive is and what the benefits of a captive insurance company are. So firstly, what is a captive? A captive is an insurance company owned by a non-insurance business that insures the risks of its parent and/or affiliated companies. It is similar in many respects to a conventional insurance company and is usually formed in a specialized regulatory domicile, such as the Isle of Man. A captive makes risk financing more cost-effective, which in turn reduces cost of risk. It controls budget that is allocated to risk management. Many companies use a hybrid approach where the captive covers the anticipated or attritional losses, and then above that, the traditional insurance market covers the larger, less frequent losses. With the appropriate risk retention levels combined, the right risk management culture in place, the organization can take comfort that its premium is effectively paying its own claims rather than the claims of other companies. Captives can cover practically every risk underwritten by a commercial insurer. The type of company forming a captive can range from a large multinational to a non-profit organization. The captive functions in the same way as a commercial insurance company and is subject to regulatory requirements, including reporting, capital, and solvency requirements. Most domiciles have specific captive legislation that is more pragmatic and relevant than those imposed on commercial insurance companies. There are several financial benefits. Firstly, cash flow. When a company pays premiums to commercial insurers, cash leaves the organization. As claims payments are often made long after the premiums are paid, the funds remain outside of the organization. However, if premiums are paid to a captive, the funds remain accessible by the organization, which generates both investment income and the effective use of capital within the group. This substantially improves the organization's cash flow options and strengthens its financial flexibility. Secondly, reduced cost of capital. While an organization can retain higher risks without utilizing a captive, this creates inefficiency due to the high degree of uncertainty at the business unit level. It is conceivable that each business unit would set aside capital up to its self-retained worst-case scenario. Since a captive bundles the business unit risks collectively, the retained risks are shared amongst the business units and financed once only. This will free up capital for the organization's core business. Thirdly, speed of claim settlement. Commercial insurers can be slow in paying claims, depending on the complexity and the nature of the claim. Under a self-insured program, a company can manage the claims process much more efficiently, which can mitigate financial problems for its subsidiary if faced with a major cash outflow due to an insured loss. So the final point is really stabilizing risk finance costs over a period of time. So the insurance market is notoriously cyclical. Essentially what that means is that you get hard and soft cycles. During those cycles, the premium volatility is quite extreme. What a captive does is it effectively allows the organization to smoothen those costs over the duration, which is very beneficial when it comes to budgeting for that business. We're in the midst of arguably the hardest insurance market since the 1980s. So it's particularly relevant at this point in time.